How tight is the oil market so that when demand shifts, the price explodes?
Well, there's different ways to look at this, but generally, we for every million barrel a day swing in supply or demand, unexpected, we look at typically about a $20 move in prices. And again, there's many ways you can run this calculation, but think about it: 1% move in demand or supply, unexpected, leads to a $20 price move. That's the issue here. And we are probably seeing more extreme moves in natural gas because of the reduction of that price elasticity. That linkage between gas and coal is now leading to even sharper moves on that front. So clearly, hydrocarbons are in a tight spot from a supply and demand elasticity. From the response of both supply and demand to rising prices.
John, you know the rule of thumb, don't mention elasticity on air. It confuses people, but that's the heart of the matter right now. It's the ugly math of elasticities, and we're seeing it to $100.
TK, let's not bury the lead. Let's go straight to that forecast at Bank of America. It's $100 crude, triple-digit crude, Francisco, by the middle of next year. Now, help us understand the path to 100, and help us understand why you think we might get there sooner.
Well, so the path to 100 is basically being driven by tightening supply-demand conditions. We are seeing demand coming back. It's coming back from a mobility standpoint, but it's also coming back with natural gas prices rising so fast and creating substitution back into oil. And that's at the heart of the matter. The heart of the matter is that we're going to be over the 2019 demand levels sometime next summer, or maybe this winter if the weather turns particularly cold. So we are concerned about that because we have a lot less capacity. Remember, shale oil production is way lower than it was back at the peak of the cycle in shale in early 2020, and frankly, we've seen severe underinvestment in the last 18 months. And I'm not sure that underinvestment can be easily corrected because now we're moving into a green economy. And guess what? I mean, if your time horizon is 3, 4, 5 years to recover your money, you just need a higher price. And I think a lot of companies are reluctant to make the investment because of what they're hearing from governments and investors.
And this is so important. Typically, Francisco, we would say the cure for higher prices is higher prices. Jeff Curry of Goldman, a peer of yours, this morning speaking to Francine Lacqua, saying this is the revenge of the old economy. It's the underinvestment that you describe of the last several years that is starting to bite. And I think what you're getting at here is really important. Francisco, how long we might have to live with this? Could this be years of this?
It could potentially, and we are moving into, I mean, the thing is, remember, we are moving into a straight jacket here for energy. We don't want to use coal. We want to use less and less gas. We want to move away from oil. So this policy ultimately is going to create deeper and deeper underinvestment. And the issue is we can't sort out all these things at once. And if the weather turns against us, and it has so far this year, we've had low hydro in China, we've had low wind in Europe. Now, if we have a cold winter on top of it, things are going to get complicated because we are depending more and more on renewable sources. And we don't have the industrial scale batteries required to store that energy throughout the year. So I think that's where the challenge is, in my view. So yes, it could be a multi-year period until we finally transition to a green economy where things are calmer.
Francisco, this backdrop is bullish for oil prices, and we've already blown through some of your forecasts for September when it comes to Brent. I mean, how much are you bringing forward the idea of triple-digit oil prices?
Right. So we've been saying it was going to be a summer 2022 when global air traffic recovered. And remember, at the end of the day, the biggest gap in global demand has come from the airline industry. We've shut down most of airline travel. But now the U.S. is restarting travel in November, right? You're going to be able to travel into the U.S. from all around the world if you're vaccinated. At least that's what the guidance seems to be. So we're going to see a resumption in international travel. Demand for jet fuel is going to pick up. At the same time, we're going into winter, and we don't have enough gas to keep the world warm, and that's going to lead to a surge in demand. So it could potentially happen sooner, the $100 oil, and I think that's where the winter premium plays a big role here.
So how high could oil prices go? I mean, if we're talking about $100 barrels by September next year at the latest, based on the current dynamics, could we get to 110? Could we get to 150?
Well, I mean, I don't want to create necessarily headlines without writing them before, because otherwise I get into trouble with our compliance officers. But, you know, I have to tell you, I mean, this seems to be increasingly a multi-year problem, because companies are reluctant to invest until higher prices come about. And even if prices come about, they still don't know what COP26 is going to look like. My sense is, once we get through COP26, we'll have a clear picture of what it's going to take to resolve the problem. But the climate summit will provide a lot of guidance to investors and governments and companies alike as to what they need to do here.
Francisco, very quickly here, we're out of time. Do you anticipate $100 like we saw 110 average for 4 years?
I don't at the moment. I think it's a squeeze. We've been factoring in more electric vehicles, a transition away from hydrocarbons. But again, we have an underinvestment problem that we can't solve easily. And at the same time, we have surging demand because we keep printing all this money. And my concern is prices for oil and other commodities spike. And what are we going to do? Are we going to say this is transitionary and we're going to keep feeding more money and increasing our debts, our government debts to cure the problem? That's definitely not going to help our transitory inflation story. I think it could make it more entrenched, but I'll leave it there. But I mean, I think at the moment it looks transitory, but I think it becomes more permanent if we use the same tools we have, fiscal and monetary, to address what's essentially an undersupply problem right now.
Interesting.